these are times to be careful, because whenever the US is in a tizzy, there is collateral damage. Every time you hear be greedy when others are fearful, be fearful when others are greedy, every time you hear that, please remember the most important word in those statements is not greed or fear. The most important word is the others. I always remind people that in the last 20 years, the Nobel Prize in Economics has twice been given to people who study human behavior.
How do your managers go out and select companies? Is it valuations?
Yeah.
Is it growth opportunities? And simplify this. Everyone likes to talk about growth and value. But let's dumb this down as much as we can. Do you buy? What do you buy? And how do you buy? And how much do you buy?
We have a benchmark.
Yeah.
So we are benchmark aware when we manage a mutual fund. We don't do crazy things. And I think everybody of my age profile needs to take a chill pill here.
Hello and welcome to Capital Conversations by Waterfield Advisors. Today we have with us Aashish Somaiyaa, CEO of WhiteOak Capital Asset Management. Aashish, thank you for joining us today at Waterfield Advisors. We've spoken multiple times, but whenever we've spoken to you, it's always been about your view on the markets, SIP, business at large. Today, at least I want to start the first half of this conversation talking to you as Aashish the businessman. And this sort of resonates with a lot of our viewers because most of the families we work with are either founders or first generation entrepreneurs or multiple generation entrepreneurs, right? But Aashish, the entrepreneur, you started your career, your early days were at ICICI Prudential AMC, to building out WhiteOak with Prashant Khemka. Was it luck by chance?
Yeah, I mean, if you really ask me, there are many times when somebody's asked about their professional journey or careers or business journey, and you hear a perfect backstory. I'm very, very wary of a perfect backstory. So yeah, I would say luck is always a very, very big factor. So it happened like straight out of college, I was a summer trainee with ICICI Mutual Fund. So first, say 12 to 13 years. And back then, ICICI Mutual Fund also, while I was a trainee, but ICICI Mutual Fund itself, the assets were like 150 crores. So I had a long stint with them, about 12 to 13 years. And I moved out of there as a head of retail business, covered sales, distribution, marketing, products, multiple things. And then 2012 end, I got roped into Motilal Oswal to be CEO of their asset management company. So that was also in they were re-strategizing. It was like in the formative stages. So for 8 years, I was responsible for helping them strategize and build their asset management business. And 2020, Prashant.
How old were you then?
When I became CEO, I was just under 36.
Wow, okay.
So, I mean, it's no longer relevant now because you can see all the gray. But when I became CEO, I was the youngest CEO in the industry. But that was, I think a lot of that is being in the right place at the right time. So, because in 1999, when I started my career, there were not many people who were chemical engineers, post-grad in finance, but doing sales of mutual funds. I mean, everybody with my background, nobody wanted to be in the business side of it. Everybody wanted to be analyst or portfolio manager. And so that was one of the rare moments of, I was young back then, but one of the early time in my life when I realized that what I had studied in B school is what I applied, which is competitive advantage. So the reverse of it, which is that, if everybody in my class, all the brilliant guys, everybody with my background wanted to be a portfolio manager or an analyst. And I was the only one who went into sales. So I think in hindsight, that turned out to be a good decision because I was not as smart as the other guys. And all the smart guys wanted to be investment bankers and portfolio managers. So it worked out well, I guess.
Yeah,
because there were not many people who were in sales or business at that time.
How important is doing sales as a CEO? Is that a critical role?
See, when I speak to a lot of youngsters or even a lot of businessmen or a lot of people on the outside, say social media, or you meet people in general, I think Bollywood has done a lot of damage because the lasting impression of a sales job is what, Chashme Badur, that movie where Miss Chamko was going around ringing doorbells and selling soap. So I think that whether it is youngsters or whether it is some of the older people, the general impression of sales is that, people are ringing doorbells and trying to sell you something, knocking at you all the time.
Yeah. And it's looked down upon for some reason.
Of course it is looked down upon. But I think 2-3 years, now I'm nearing 50 years of age and I can tell you that everybody is selling all the time. Okay, there are some people who just show off intellectual firepower, but they are selling themselves, right? The Prime Minister is fighting an election, he is also selling himself, right? So everybody is selling all the time. And every CEO, every portfolio manager, everybody. I mean, you're selling yourself to your spouse also, and I'm selling myself to my son also, at some level, right? So I don't think there's anything wrong with it. I mean, human beings are social,
Yeah.
and basically you're selling all the time. It's just that in our industry, selling is very technical because I have to understand what the finance minister speaks. I have to understand what some economist writes in his tome. I have to understand what analysts and portfolio managers are speaking. But I have to explain it to a guy who's investing 100 rupees a month, maybe in Ichal Karanji, when I speak to a large audience, right? So selling is not what it is thought to be. You are actually influencing people, their minds and their opinions. And I always tell people, the world is not as needy and as greedy as you think. Sometimes
Yeah.
we are doing it purely out of passion.
It's holistic and it's a good thing. It's
Yeah.
good for you.
Yeah, it's a passion. I mean, if you want to evangelize something, if you want to get people onto a certain path, and you have no malintent at heart, like I've been doing it for 25 years, and
Yeah.
I think the industry has made money for a lot of people.
Just talk about your career, right? You moved, like you mentioned, you moved from Motilal Oswal. Those were early days in the Indian financial markets, right? Retail participation was nowhere close to what it is today.
Yeah.
You took the plunge and became an entrepreneur in some ways with Prashant Khemka. How was that? And also now, as we look ahead, where competition has intensified, the journey ahead. Is it as glorified as the past behind you? Is it going to be as easy, or with increased competition? The good thing is there's more awareness, but the other thing is that it's competitive now, a lot more competitive.
Yeah, I mean, so both the times, like when I was recruited to help Motilal Oswal build the asset management company, and then, of course, when Prashant was kind enough to invite me on board. I mean, in both these cases, the entrepreneurs are obviously the founders themselves, and I
Yes.
see myself more as a professional entrepreneur, as a
Yes.
professional CEO, because it's not necessarily my capital on the line, but definitely I'm going there as an entrepreneur to build, with a plain piece of paper and a pen, and start drawing out organization structures and start building their strategies and the differentiation and everything that goes with it, right? So when you go with a plain piece of paper and start writing every process, it takes a lot, but obviously it's not my capital on the line. I'm more a professional. But coming to the point about competition, I feel that we've just scratched the surface. I mean, see, because in the last, I mean, while people like me have been around 25 years, the real growth has come in the last 5 years, or maybe in the last 10 years at best. See, what happens with human beings is that we spend a lot of time in forecasting the future.
Yeah.
And when the future is actually upon us, we don't recognize it, right? So since 20 years, I've been hearing that India will become a middle class country. For 20 years, I've been hearing that people will move from traditional investments to capital markets. For 20 years, I've been hearing that India's demography will change. Now, when it has finally arrived, you are hearing things like, oh, all these youngsters, they've come after 2020, first sign of trouble, they are going to run away. These
Yeah.
kinds of things you hear. Or you hear that, why so many SIPs are being registered, why so many broking accounts are being opened, why there are so many asset
There's just
management
no wind.
companies, right?
Yeah.
Why so many asset management companies, why so many wealth managers? Now, here's just two statistics. One is that in India, 21-year-old, 22-year-old, 23-year-old, take any age, there's nearly 2 crore people. So some of them, or a lot of them, are going to start earning and start investing. The second statistic, say 10 years, 12 years back when I moved to Motilal Oswal, for example, in 2012, I was drawing out some plans. So I remember the equity mutual fund business, the assets was 1,79,000 crores in 2012.
Okay.
It's north of 20 times in the
That,
last 12
yeah.
years. So obviously, if you have such a huge client base and such a huge accretion to the AUM, it will happen with new players. There will be
Yeah.
competition. But there is place for everyone. You can't expect that the industry will grow 20 times, but it will still be the incumbents who will.
Yeah. It's got a pull factor as well, right? If it's a
I
growing
mean, 15
industry.
years back, I don't know. I mean, how many private banking outfits there were, and now, like say Waterfield, highly successful, right? But 15 years back, we didn't know that there'll be huge,
Surge
successful
of,
private
yeah.
banking outfits, right? India is the third largest number of billionaires, so you're set to grow, and so is the rest of the
And
industry.
so are you. Ashish, and I want to talk to you about this because you alluded to the fact that in the last couple of years, even the regulator, right, has commented on how the 21 and 22-year-olds are becoming traders.
Yeah.
Very few people are joining the workforce because they feel like it's easier to trade and make a quick buck. What are your views on that? Because you could actually, on one hand, yes, it could be risky, but on the other hand, you could actually be an intelligent person who's making trading a business. How do you feel about that?
So I think that all of us, like, say I'm 49, nearing 50, and I think everybody of my age profile needs to take a chill pill, like I'll tell you why, because our bunch is very preachy, very preachy, because what happens is that, first of all, let's clarify that if you're talking about 21-year-olds, 22-year-olds who are, say, trading in the market, basically there's about, the NSE says that there are 12 crore unique, people with demat and stuff. And there are 18 crore demats, but 12 crore unique investors. So let's understand, we're not talking about 142 crore. We're talking about 12 crore. Second point is that people who are 21 or 22-year-old today, if I start thinking about them, or if I view them from my lens of what I was when I was 21-year-old. When I was 21-year-old, India was a poor capital deficit country. And the stock market was all about Harshad Mehta, Ketan Parekh, and, before that, whatnot. Right? It was the Wild West. But today's 21-year-olds, the stock market that they are in, right, the regulatory framework, the technology, their socio-economic background, the India that they live in, or the India that they envision versus what I thought 25 years back, there's a world of difference. It's a different human being that you're talking about. It's not us. It's not me. So I think people who are 21, 22-year-old today, the good part is that they are discovering all of this very early in life. I mean, when it comes to capital markets, everybody will have their own journey. When I started my career, most people's journey was about losing money with the Harshad Mehta boom. Right. When I started, for most people, the go-to investment was, RBI issuing Government of India relief bonds. When Government of India used to borrow at 12%, risk-free and tax-free. So today's 21-year-old will have a different journey. Some people will come through IPOs, some will come through mutual fund SIPs, some will do FNO, some will become a stock picker. But I think they are better resourced, better educated, they have a much higher risk profile, and they are not from the same country which I am from. Technically it's India, but different place.
I think it's natural progression as the country goes from a developing to a developed nation over the next decade, right? I want to talk to you about the markets because I think it'd be unfair if you don't. We've had it tough. The end of 2024 was difficult. Now, of course, everyone has said that we've recovered in the last few days from all the losses of 2025. Newspapers, TV channels will call it a bear market if the market falls for 5 days. Then they will call it a bottom if it goes up for 2 days. So this gets very confusing, and it gets confusing for investors because, one, it creates panic. Second, it creates a lot of the unknown. While I know everyone is sitting in their offices blaming Trump, the reality is this is natural. There is no free lunch. And you've called the market a pendulum. Now, you want to elaborate on how you feel about what's happening today and what investors should keep in mind and why they should take this with a pinch of salt when they talk about bear markets and bull markets in weeks.
So, couple of things. Like, I'll obviously talk about the cyclicality. I mean, even someone as famous as Howard Marks refers to the stock market as a cyclical phenomenon, and that is obviously well manifested when you look at pendulum as a physical object, right? But before that, two things that I want to share. One is what all investors and viewers at large should keep in mind is that almost every year or 2 years from the highest point, the market does decline 15-20%. It's not new. As they say, it's a feature, not a bug. At every time the reasons will be different, but whenever the market makes a high, from the high point it falls 15-20%. It's very normal. Just to give you examples, before COVID, the high point was 12,490. Right? Then we had the COVID fall and then an up run. The highest point was 18,490. So every 2 to 3 years it makes a new high. And then from the high point it loses 15-20%. But the other point is that because we are in a growing economy, because corporate earnings, GDP per capita, everything is on an increasing trend, the market does tend to make higher highs and higher lows. So it doesn't really retrace the whole movement. So there's nothing to worry. Every time there's a different reason. In 2022, people thought we'll have a third world war. In 2024, people thought NDA will lose power. In 2025, people think, all the FIs are just going to sell pretty much everything and just go away. So every time there is a different fear.
And just on that point, and we've been talking to a few clients recently, and I don't know where they hear these things, right? But suddenly everybody's talking about doomsday. Buy gold, but don't buy paper gold. Buy physical gold. We don't know what is going to happen to the world. And a lot of that, I mean, it's difficult, but I don't know who these naysayers are, because the panic is there. And the panic, like you said, comes up every few years, and the excuses and the reasons are varied.
Yeah, so see, it's all about human behavior, because we keep saying be greedy when others are fearful, but exactly when the moment comes, we join the others.
Yeah.
That's the whole challenge. But I would put it this way, that if you look at the current environment, yeah, I mean, it is tricky, and we are going to have slightly challenging times. The reason being that in the past it has been seen that when the US economy starts correcting, if the US economy is expected to slow down because of Mr. Trump's actions, because of the Department of Government Efficiency, because of all the disruption that they're causing. Plus, AI, nobody's using the word bubble, but you have started hearing words like hype, started hearing words like mania, because all of that massive investment, per company, $80 billion, $100 billion of investment into AI infrastructure is now being questioned. That, what type of results will it actually bear? So, whenever the US economic performance is going downhill, or expected or feared to go downhill, whenever there is disruption to global trade, whenever a massive stock market rally is questioned, and so now all these magnificent 7 companies are more than 20% down from the peak. Nasdaq is about 12-13% down from the peak. So whenever there are questions around US economy slowing down or the US market likely to crash, it causes flutter across. So these are times to be careful, because whenever the US is in a tizzy, there is collateral damage. But what we should not forget is that every time the US corrects in a big way, it is accompanied by falling yields and falling dollar. And that kind of drives money to emerging markets. And that is also what drives money towards gold and other commodities. So we just have to be watchful for the, say, rest of 2025, or say the next, middle 2 quarters of 2025. I think one has to be watchful.
Okay.
But take advantage of it if you get a downside.
Does that mean, of course, not on the mutual fund portfolio, but do your fund managers on the PMS side and the AIF side, are they fully deployed at this stage, or are they sitting on cash?
So, our worldview is that we are heavily dependent on private bankers like you or wealth managers like you to manage the asset allocation.
This is great. So you all allocate as the funds come through. So you're 100% invested, because you're expecting the banker to take the cash call.
Yeah, because you might be dealing with somebody who has a 500 crore portfolio in which you allocated, say, 50 crores in equity, and say 10 crores finds its way on my table, and on that 10 crores, if I put 20% cash,
it only confuses the system.
I'm just second guessing the client's allocation all the way.
Yeah.
So, and there's the second other thing, and I'll just ask you on a lighter note, just as a joke. How do you beat Mr. Vishwanathan Anand?
You don't play.
Yeah, you basically don't play chess. Don't challenge him to chess. Do something else. That's the point. We are supposed to beat the benchmark by being in equities.
Not by being in cash.
So why do we have like 33 analysts covering like 1,000 companies? Because we are supposed to do superior stock selection, and we are supposed to generate alpha from stock picking. If I generate alpha by being out of equity,
how are you going to beat it?
It's just purely luck, right? I mean, it will look good when the market is falling, but if the market turns around, the very same question the client will ask, or you will ask as a private banker.
Why didn't you allocate?
Yeah, I mean, it's above our pay grade to kind of second guess anybody's allocation.
So let me switch this around. What have you done with your own money at this stage? Are you sitting on cash on your own portfolio?
No, not really. I mean, I'm perpetually over-invested. I never seem to have cash, actually.
Really? So all the money that you get in goes with the markets?
Yeah, I mean, see, a lesser known fact, but since you're asking, it's a great opportunity to educate people. Our industry has a regulation that 20% of our post-tax compensation, it may be variable compensation, it may be fixed compensation. 20% of post-tax compensation is per force deducted and invested straight into the funds, and it is not accessible to us for 3 years.
So you've got skin in the game.
I mean,
more than just earning revenue
more than that, because
allocation.
Yes. So always fully invested. I mean, I think that trying to take cash, so you never take it at the peak. So when it starts falling, people get into cash. So they lose the first 10-15% on the way down, right? And by the time they deploy, they lose the bottom 10-15% also, because nobody. So I don't think it makes really a lot of sense. And in a long-term journey, It makes you feel happy for 3-6 months, but in a long-term journey, I don't think it will count.
Talk to me about selection, right? But how do your managers go out and select companies? Is it valuations?
Yeah.
Is it growth opportunities? And simplify this. Everyone likes to talk about growth and value, but let's dumb this down as much as we can. Do you buy? What do you buy? And how do you buy? And how much do you buy?
Sure. So obviously, all credit to Prashant and our CIO Ramesh and the team, because we have one of the largest investment teams in the country, like by a mile.
Yeah.
So WhiteOak manages nearly 9 billion of assets, but we have like 46 people in fund management. And by the way, that's entirely equity.
Oh, wow.
So it's a very large team. We have very wide coverage of the markets. Coming to your question, I completely agree with, we don't actually follow this growth and value.
Yeah, and it's all very confusing, yeah.
Because at some level, if you see, the world has moved on. I'm in 2025, and if I read Benjamin Graham in 2025, I can't imagine the world has gone back to 1949.
Irrelevant, yeah.
It doesn't work that way. I think in today's world, what happens is that mispriced growth is where you find value. There's nothing called value as in static value, as in you will not get a dollar's worth for 50 cents. We're not in that day and age at all. Because there's no information arbitrage, and information is available to everybody at the same time. So you have to capture value from the future growth of a company. I don't think you're going to find value which is like undervalued relative to what it has already done, or undervalued relative to its books, etc. So how do we identify value? Basically, we are looking for companies where we think that the future cash flow, right? So 2 or 3 things we look for. One is we value all businesses purely only on cash flow.
Okay.
Because it's well stated that value of a business is present value of its future cash flows. It doesn't say future PAT or EPS.
Yeah.
Right. So one is that for every business that we evaluate, we restate the financials in 2 parts.
Yeah.
One is that we simulate as if there is a financial company and there is an operating company.
Okay.
And we simulate as if the financial company is owning the capital, fixed assets, working capital, fixed capital. Everything is housed in the financing company.
Okay.
The operating company is the one which is responsible for product development, brands, marketing, sales, distribution, the operations of the company. And then we simulate as if the financing arm of the company is providing the fixed assets and the capital to the operating arm of the company at a cost.
Okay.
So the operating arm of the company has to do sales, etc., has to generate revenue. The first thing we will do from the net revenue of the operating company, we'll simulate as if this operating company has paid 11% of whatever capital is used. We'll simulate as if it has paid 11% or 12% to the financing arm of the company.
Okay.
So what is left with the operating company is what we call excess free cash flow. Right? See, in the market,
after paying the 11% to the finance company.
Capital, because see, in the market, what happens? In the market, whatever is the excess cash flow with the operating company, people put a PE multiple to that and say, wow, great, this is the profit, multiply 20, 30, 40 times, But the point is like this, that if you have a business which does not even pay more than 12%. If there is a business which after paying the cost of capital has no excess cash flow, then it doesn't deserve that multiple. You're not even paying the cost of capital. Those multiples are richly deserved only for the cash flow which is in excess of the cost of capital.
Right. Does it ever happen, Aashish, where you're positive cash flow but not profitable? So, and then what do you do in that case?
Yeah, so see what happens, like a lot of these new age companies, that is precisely the debate or discussion. See, what is happening is that if you set up a steel plant and you spend say thousands of crores, our accounting norms are such that those companies will come across to you as profitable. The reason is because they are allowed to depreciate over 15 years.
Yeah.
But these new age companies, they may have positive cash flow, right? But you're not going to allow them to depreciate anything. So they'll perpetually look like they are loss making, because there is cost of, say, you're hosting stuff on the cloud. Say you're paying software development charges. Say you have a huge employee base, which is digital marketing. Some of these companies, they spend thousands of crores just to get into your app, just to get their app into your phone. So if a steel company sets up a steel plant they incur a few hundreds or few thousands of crores.
Yeah.
It's depreciated over 15
Yeah.
years. But if a new age company spends that much money to get into the mobile phones of say 15 crore people, do not allow them to capitalize that.
Correct, because that, yeah.
Right. So what happens is that actually when you do, when you do your investing analysis, you need to normalize for these
Both,
kinds of
yeah.
things. Because, see, some of the universities nowadays, they have a course called accounting for investors.
Oh, okay.
Because it is well known fact that
Yeah.
the financials that you receive from companies, that is accounting for the taxman.
Correct, not for an investor.
That is accounting for the regulators and the taxman.
So it's
The
fair for
accounting
me
for
to say
investors has
that-
to be very different.
Yeah, this excess cash flow are the companies that you like.
Yes.
But in the tech space, they won't be profitable.
Yeah.
Okay to say that that's fine for you?
Yeah, that's fine. In
But
fact,
if a steel company is not profitable but excess cash flow is visible, would you invest in them?
yes, of course. So see, in fact,
So profitability
the way,
is not something you're looking at.
so yeah, exactly. So saying that accounting profit as a tick box is not relevant. In
Anymore.
fact, because right at the start, before you asked the question, I said that we evaluate everything on free cash flow. Correct.
DCF, yeah.
So you are going to normalize. In fact, the methodology that we use, it normalizes.
Yeah.
And it just basically focuses that per unit of capital invested, how much of excess free cash flow
can
are
you
you
generate on
going
that?
to generate?
Yeah.
And we are valuing the financing company separately. Once you paid the cost of capital, that is done. The real value of any business is only in the operating company, not in the financing company. But if you go to the stock market, people value both of it as a combined unit. Right? You're not supposed to value it as a combining unit because I am an external shareholder. I have the luxury of deciding to
whether I
put
wanna
money
buy
somewhere
money.
else.
Yeah.
Right? So I will only put money with somebody where the operating business is generating genuine excess free cash flow after paying the
Finance company,
financing
which is part of them. Right. Your stable has recently launched a mutual fund, not recent anymore, but it's been a while. And this is interesting, right? Because if you look, actually, let me start by asking you this. If money was not a problem, so your minimum ticket wasn't a problem, and an investor came to you and asked you, mutual fund from WhiteOak or PMS, which one would you pick?
So, there are three things we manage. We manage AIFs also, we manage
PMS.
PMS and mutual funds. And I think it's horses for courses. If you ask me, let's take a pertinent example. In the last 6 months, there's been a lot of hue and cry about people putting money into small caps. And then, the regulator saying that you need to disclose your liquidity statistics. And, small cap has been volatile, all of these. Now, take an example. We don't manage a small cap mutual fund. We have every mutual fund, but no small cap.
Yeah.
So, now when you talk about small cap and illiquid, plus, there are 50,000 crore size small cap fund. And they're restricted to investing in the top 500 stocks or something, top 250, 1 to 500, right? So we don't have an open-ended fund. So when you tell me small caps and illiquids, I would put it in an AIF, right? Clearly, because in an AIF, what happens is you can do partly pre-IPO or non-listed.
It's a better mix.
You can do SME, micro cap, small cap, right? You can have a fund which is gated. So you allow exit once in 6 months. You never have a liquidity challenge. If it's a AIF, it's never going to become 50,000 crore. We raise 5, 6, 700 crores and close the fund. Right? And it delivers stellar performance. And along the journey, some of those pre-IPOs will obviously get listed where we have invested, and they will also add to the return. So in certain scenarios, clearly it's AIF. Now look at mutual funds, for example. It's ideal, retail investors, long-term investors. Plus, what happens with a mutual fund? Typically, we have an offer document. We have a benchmark. So we are benchmark aware when we manage a mutual fund. We don't do crazy things.
Okay.
By crazy things, I mean that we don't run portfolios which are agnostic to the benchmark. 20% deviation from the, a sector is 20% in the benchmark and you are 0. All that doesn't happen in a mutual fund. You are running it to have consistent, we are running it, not everybody, but we are running it to have consistent above average alpha. Meaning, if we do well, we are top quartile. If you do badly, you'll end up in the middle. And you are aiming for a sustained, consistent, positive alpha. That's what we do in a mutual fund. Now come to a PMS, for example. Let's understand one thing, that in India, even today, after so much of mutual funds sahi hai and 46 lakh crores in equity mutual funds and all, even today, the value of direct equity held in people's demat accounts is bigger than
the mutual funds.
The mutual fund industry.
They all think they can do it better than the fund expert.
Yeah, of course. I mean, the regulator says that 91% of the people lose money. The irony is that the 9%, all the 100% think that they are in the other 9%. So,
Yeah.
so that's not going to change. See, as long as human beings think, in a room there are 100 people.
Yeah.
If you ask all of those people, how many of you are a above average driver? How many of you are a above average parent? Most of them will raise their hand. But the truth is that only a certain proportion is above average, right?
Yeah.
Only 49% of the people
But
can be
nowadays
above
we
average.
say, the best competition is yourself. You should not compare to other people.
So I was trying to say that as long as 50%, as long as 100% of the people or 80
Yeah.
or 90% of the people think that they're above average, they will be chasing trading and
Returns.
investing
Yeah,
and
yeah.
those kinds of things. So the direct equity cult is still bigger than managed products. We don't expect all of those people to sell all the stock and move into a mutual fund. A lot of them are comfortable having a portfolio
Yeah.
management service.
Yeah.
Plus, in a portfolio management service, all the restrictions that the regulator has on standardization of products, on commercial aspects like fees, profit sharing.
Yeah.
A lot of those things you can't do in a mutual fund. You can only do it in a PMS.
Right. Now, explain to me this, and I think this is for some of our viewers as well, right? Let's talk about the PMS first. When should an investor choose a flat fee versus a profit share?
I think in most cases, flat fee works better
Okay.
because,
For the investor?
for the investor. So, because what will happen is that in a performance linked fee, there are again different ways, but let's look at it this way. Let us say that some cases people put a hurdle as a fixed income rate as a hurdle. So, say that 8% is the hurdle.
Yeah.
And then you say that, okay, anything which is say 20% over 8% is what the manager will charge.
Yeah.
There are these kind of structures.
Yeah.
Now, that's not a great structure. I'm not a fan. I'll tell you why. Because every once in a while, year like financial year 2021 will come.
Yeah.
In FY21, what happened is that I know of PMSs. In FY21, the index went up from 1st April 2020 to 31st March 2021.
Yeah.
Index went up some, BSE 500 went up some 69%.
Yeah.
I know for a fact our PMS went up 71 or 72%. There are some PMSs which went up 50% or 55%.
Below the benchmark.
Now what happens is that at that time, our performance link fee was that we will charge performance fee on the alpha.
On the benchmark.
On the alpha over the benchmark. So I'm going to charge profit share only on the 2-3% excess return which I have charged.
And what was the profit share on the 2-3% excess?
Hardly few basis points.
Okay.
Right, because we take 30% of alpha.
Okay.
So on 2% of alpha, we might have charged 60 basis points.
Okay.
That was our arithmetic for the fee.
Yeah.
So for us, commercially, financial year 21, when everything is rising up, when entire BSE 500 goes up 69%, 72% is a stellar number because a 500 stock index has gone up 69%.
That's phenomenal.
And still you
and
beat
you've
it.
created alpha on that is pretty significant.
But still, the way we price it, it was 30% of 2%, so 60 bits. Okay, but there were very many PMSs which says 20% over 8%. Now imagine, even if they underperform the benchmark, let's say they delivered 60%.
Yeah.
Okay.
So I've paid on 52%.
On 52%, you paid 20%. That is actually happened. It's factual. It has happened. So what happens is that when you do a performance linked fee, it's ideal if it is on alpha. But if you do performance linked fee over a certain hurdle, even if the hurdle is 12%,
it's only the fund manager.
Once in a year, once in 5 years, a year will come when you will
give
pay for the entire 5 years.
This is such a good point because we as advisors and independent conflict-free advisors are very big on telling our clients and families we work with a flat fee is the right way to do it.
Yeah, because if somebody says that, okay, I'll just charge you 100 bips flat fee, then you are done and dusted with it. Whether
And we also believe that the manager is getting incentivized enough to create alpha because you're paying him a fee.
And if you go for performance link fee, then you should go for a fee which is charged only on the alpha.
Over the index. That is very interesting. Just another one on the PMS mutual fund, right? This is what we've understood, and please correct me if I'm wrong. We understand there's a little bit of an overlap between the PMS and the mutuals. Do you agree? Is that conscious?
Yeah. See, for example, look at it this way, that WhiteOak as a house has a particular thought process, has a particular philosophy. in the industry, all the folklore and all the discussion is about stock picking, and we do a lot of work because there are 33 analysts covering like nearly 1,000 companies, I told you, which means we are bottom-up stock pickers and we are passionate about stock picking.
So you want to bring it to
But
everyone.
as far as fund management is concerned, and when you're speaking about beating the benchmark, as in professional fund
Yeah.
management, it's not just stock picking. Then portfolio construction is very important, right? Because you are constructing a portfolio to beat the benchmark,
Yeah.
and there is a lot of science. I cannot make a portfolio in isolation. That okay, these are the. I mean, when you ask me how do you do pick stocks, I said we look at free cash flow, ROIC
Yeah,
over cost
yeah.
of capital. We will look for good governance. We'll look for long-term growth. But a portfolio is not just to. I just don't buy a portfolio of stocks which I like. I mean, I just buy a list of stocks which I like.
Yeah.
If you have to beat the benchmark,
Go to more than just
then
that.
there is a lot more science to it because your portfolio has to have some awareness of what the benchmark is doing.
Yeah.
Now, when you look at our PMS and our mutual fund, you're right in saying that there is some overlap, maybe 50-60%
65
overlap.
is what
Yeah,
we understand.
65%
Yeah.
overlap. But that will be, I mean, varies from time to time. But that is because as a house, we have a philosophy. When it comes to the mutual fund, we are quite, I would say, benchmark aware
Yes.
because we believe in something called a balanced portfolio construction. So when we say we are benchmark aware, what we mean is that when you look at the factors which drive market performance and when you look at sectors which drive performance, we don't have like a massive, very huge deviation.
Okay.
The entire deviation is just the stock picking. When you look at the PMS, it has a much larger deviation from benchmark. Because in the PMS, we are just buying stocks, predominantly buying stocks which gel with our philosophy and our long-term thinking.
Okay.
And we do limited amount of risk management vis-a-vis the benchmark.
Yeah.
But when it comes to the mutual fund, we would love to buy stocks which only gel with our philosophy or long-term thinking.
Yeah.
But we are painfully aware that we have to beat the benchmark as consistently as possible because it's a retail product. So there is a lot of risk management which ensures that the deviation from the benchmark is controlled.
Okay. And I think the onus then sits on an advisor like us to help our clients, either pick the mutual fund, the PMS, or the AIF, right?
I mean,
All you've
pick
done
it
is
with the right expectations,
created
yeah.
a buffet of services that cater to different sort of objectives in that sense. Let's do a few quick takes now, Prashant. And this is, it's not as exciting as Karan Johar's Coffee with Karan, but we'll try and do whatever little we can. Who's your mentor?
I mean, I've been lucky, multiple mentors. Like, my first boss was Pankaj Razdan, then Nimesh Shah in ICICI, Nilesh Shah in ICICI, Mr. Oswal, Ramdev Agarwal, Naveen Agarwal, and now
They're all your mentors, huh?
Prashant Khemka, yeah.
Is Prashant also a friend?
Yes, I mean, he's very good to work with.
Yeah.
Yeah, I mean, from all, why I said I've been lucky with bosses and mentors and, the founders who I worked with, is because if you see all the names that I have told you, they all are very well regarded.
Yeah.
And I don't, and many people have many bosses, but I've been lucky because I've had a string of great bosses. And all of them have been, teachers and friends and mentors and sounding boards. And I can also tell you all of them are, great at demonstrating. I was told very early in life that demonstration is the best form of leadership.
Yeah.
Yeah. So,
You lead from the front.
yes, and you should be living what you are preaching.
Yeah, yeah.
Yeah. So a lot of learning.
Yeah. Well, this is again a financial. So, best personal financial investment that you've made. I'll put the personal in because, or the financial in because then you could say my wife or my child or any of those, right? But best personal financial investment that you've made.
I think that being somebody who is a salaried individual, but having a high ability to take risk and be a professional entrepreneur.
So it's a great mix.
It's turned out well for me.
Yeah.
It's turned out well for me, so because I've been involved with setting up businesses twice or thrice over now. And I think that has worked very, very well. And I learned very early in life that, if you're a salaried individual, like I am a salaried individual. But people who are salaried individuals, in their head, they are fixed income oriented because they want a paycheck.
Yeah,
right?
Yeah. So they're actually conservative.
So in your investing, you must be equity oriented.
You can marry both of them.
Yeah, because if you are at heart, if you are fixed income by profile, then in your investments you must be equity oriented.
And vice versa.
And yes, but the real world is like this, that the entrepreneurs are the ones who are equity guys. Yeah. So the guys who take risk, they take risk all the way through,
Yeah,
and the
yeah.
guys who don't take risk don't take risk at all. Yeah. So I've given you long explanation, but I think in my journey I've been able to
Both.
marry the two by being a professional entrepreneur.
Yeah, you've had a very successful career so far, with be it building on Motilal on the business side, WhiteOak. You said you're nearing 50 now. The next 10 years belong to WhiteOak, you think? Or
Yeah,
the
yeah.
serial entrepreneur in you, stroke salaried CEO?
No,
What
I
about the
think,
aspiration and
yeah, no, but
dreams?
Samina, in 25 years, predominantly I had two stints in ICICI, but that was 12 to 13 years in ICICI and 8 years in MO.
And how many
So,
years now with WhiteOak?
4.5 years.
It's a long
So,
way to go.
yeah, so I think, when I met Prashant, I was obviously, like you said, is he a friend? I think he's a great professional and a great founder because what he has built, I work with him for the domestic business, but what he has built in India and globally, I think is commendable. So I don't see myself doing anything other than,
Yeah,
working
and I
here
think in some ways,
as
of
long
course,
as I
this is
can.
somebody from the outside, but he's also based in Singapore. So very clearly, he's empowered you and given you the space
Yeah,
that you
yeah, yeah.
need to be
He's
able to
a
thrive and succeed, right? Also, one sort of advice that you have for young people like yourself, because I still believe 50 is young, but truly young. I mean, a 25, 30-year-old who's seeking advice on the career front, evaluating whether having a career in markets, one way or the other, is an option.
You see, everybody needs to be in the market some way or the other. Even if you're a businessman running your own business. But I think awareness about the prevalence of capital markets, the linkage to capital markets when it's raising money, when it's about deploying money, right? And I also, as a widely accepted gauge of what is happening in the world and in the economy, I think everybody should work hard to understand markets better. But I think the only advice is that people often get misled in thinking that markets is all about maths. It's not about math. It's not just about finance. The market is a lot about your psychology.
So, investing is more art or science?
It's a mix.
It's
I
a
mean,
mix of
definitely
both.
a mix. A lot of people think it's a lot of math. That's why I clarified. It's and I love to point this out to people as many times as I can. I always remind people that in the last 20 years, the Nobel Prize in economics has twice been given to people who study human behavior. So that is something you should never forget.
So, bet on the founder, not on the numbers.
Yeah, absolutely.
Yeah, yeah. Just as we sign off, just one sort of quote, mantra, book, maybe that you remind yourself every time you're having a tough day at at work.
So, I think that, a tough day for us is, when we are dealing with, say, 2020 was very difficult, for example, right? 2020 was very difficult because in a day I used to speak to, do some 4 or 5 webinars,
Oh,
do a
really?
lot of
Just
public
calming the
speaking,
nerves.
yeah,
Huh?
talking to people. Very difficult to talk to people 10, 12, 15 times a day when they are 40% down on their
Yeah, what can you
investment,
say? Yeah.
right? But I do remember at that time I had written a note where I said that usually there is a bear case, there is a bull case, and there is a base case. But in times like this, there is only, world will come to an end case or the world will not come to an end
Yeah.
case, right?
Yeah.
So I think, what is important is not to lose your own mental balance and, stay calm.
Stay calm.
I think that those things are more important. And in my entire career, I've always learned again and again. I've had experiences which tell me it's the math which is less important. It is more the psychology and it's more your disposition and your emotional control. I think those things are usually more important.
Ashish, the investor, is an optimist or a realist?
I'm an optimist.
And Ashish,
Absolutely.
the businessman, is an optimist or a realist?
Always optimist. In every walk of life.
Just
Always optimistic.
I think you've already told me the one mantra, but just to close this out, one piece of advice for investors and the bracket doesn't matter, right? So retail investor, an ultra HNI, or just an entrepreneur.
So I'll tell you this. It's a spin. I'll tell you. See, everywhere it's the most quoted is be greedy when others are fearful. Be fearful when others are greedy.
Somebody should just tell us how to execute that.
I'm telling you that, every time you hear be greedy when others are fearful, be fearful when others are greedy, every time you hear that, please remember the most important word in those statements is not greed or fear. The most important word
B.
is the others.
Ah,
I think people make maximum mistakes when they
follow
become part
others.
of the others, and they
Herd
lose their
mentality,
bearing.
like we call it,
Yes,
na?
they lose their bearings. This statement is plastered all over, but we forget that we should not be with the others. That is the most important thing.
Be special and be different. But thank you very much, Ashish. It was
Thank
so
you.
good to have you today. Hopefully, we'll see you soon. Thank you.
Thank you. Thanks for calling me.